Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend, all. Ira Epstein of Linn Associates with your financial market wrap-up, and we are now on Friday, the 13th. Oh boy, bad date. Friday the 13th, and this is April, of course. And we are talking, we're about 3:45 p.m. Central Daylight Time, but I'm putting out the update because we already know the settlement prices. They're going to be right in here. Now, the elephant in the room going home is Syria. That's the obvious elephant. Does anything happen? The stock market sold off, as I think a lot of us thought it would going into the weekend. A lot of people just positioning themselves, probably small bids in the bonds and the notes. You've got silver up on the day, the gold up, copper pretty close to unchanged. Platinum and palladium didn't go anywhere. And Bitcoin made a move to the upside. In fact, Bitcoin's been acting better and better since it got under $7,000. It's acting like a market that has found its legs for the time being. But in talking about the stock market, what nobody can figure out is what do you do? I mean, if it's a surgical strike, if there is a strike, if it's surgical, the U.S. and its allies hit and run and they're gone and whatever the damage was like the last time, okay, does it really deter anything? Probably not. If it's sustained length of attack, does a lot of damage. Does Russia get involved? Does something by accident happen with us and the Russians? I just read a report that several hundred Russians were killed in February from Allied attacks. You know, you just don't know. And that's the elephant in the room. Then quietly in the background, we have NAFTA, good things going on. There's now the U.S. has changed its position on the percentage of autos that have to be either made or components that are made down in Mexico or Canada to 75% from 85%. They're currently 62.5%. So they're at least getting closer. And we're hearing that the U.S. is looking at the Pacific Trade Pact again because it's going to be a ploy as they try to figure out what to do with China, which is now, what, 30, 40 days away before those tariffs may go on. I have to look over the weekend and see how many days. What I do on the weekend, different than what I do on my daily charts, is I look at first the monthly chart, then I stick with the weekly. During the week, what I do Monday through Thursday is I'll look at a weekly chart to start with, then I'll go to dailies for you. So that's the difference. Over the weekend, just trying to give an idea as to where we're at. Now, let me explain what a monthly area chart is. As you can see this green area, and you see this line. The line is comprised of just putting together at the end of each month the settlement price, just the settlement, not a high-low close, and taking the current market and putting it there. What we are right now in the market is we have fallen back. We've been in a correction phase. I'll call it a down thrust because you've taken out a pattern almost straight down. As I come in here, you can see each month that I'm comprising of. So if I go here, 28.25.75, 27.14, 26.43, and now we're getting a little bit of a bounce. We're up about 15 points, 14 points for the month so far. Admittedly, we're not at the end of a month, but you have to have a reference. So I think we've been breaking down the overall bias of the market because you're over the 18-month moving average of closes is up. So as a chartist, I say the market has an upward bias. However, the immediate move has been correction. When I go to a weekly area chart of closes, a little bit different pattern. First off, I use on this chart the 18-week moving average of closes. As you can see, the market has been under it, and it's been under it since right here when we got to, let me turn this way so you can see it, March 23rd, and we've been down and staying down. We are getting a bounce, so the thrust of the market's back up, but resistance is waiting for this market back right where that 18-day average of closes is. This is what a weekly bar chart looks like, just a regular bar, not a close only, just a bar. And as you can see, you almost can see here, the step ladder that it's forming to the downside. When I put on these brown lines, they're called a swing line. And what a swing line does is it looks to see where apexes were formed by looking at the previous week compared to where you're at. If you've got a higher week, a higher high week, the market's going to look at one way. Lower and low week, inside week, outside week up, outside week down. It's going to look and plot this line each time a different way. And I look for a pattern, because if you're in a downtrend, and I'm going to take this week off, just leave it like it was, you had a pattern of lower highs and certainly lower lows. So I'm looking at this number right here, the 2679.75. Well, if you look here, we took that out. We got to 2680.50. So I now have a pattern of a high that took out a previous high and a low under a previous low. The market is not trending. Okay. In good news, you were in a downtrend. You broke that. The market has bias to the downside since it's under the 18-week average of closes. My theory, and what I teach in my charting, is that charts like to have a neutral point. I'll call it the line in the sand. Now, some might call it, I call it the 18-week moving average of closes. You might call it the 20, 21. You'll hear TV analysts talk about the 200-day moving average of closes. Many, many different averages. Well, in futures, I feel this is a good number. You will find often, and the word is often, not always, that this number becomes an area that you whip around before a trend is decided. If you've been trending to the upside, look at 2017. Had you bought that 18-week average each time, it served you well. But notice here, for the first time, when we got into 2018, unlike all of 2017, you had a close under that number. That changed this market. I think the high of the market now can be labeled as January 29th, and since then, the market has been in a corrective nature. The question is, how long will it last? Where does it go? Let's assume that if the market rallies, I'm going to say that the first resistance is the 18-week average, 27.1235. It's really been, you round down, 27.1225. If it falls from here, a potential support zone could be the 100-week moving average of closes, and beyond that, the 200-week. I next put on a popular study called Bollinger Bands. A Bollinger Band is an algorithm written in a way to keep the market trading within the bands 95% of the time. You don't want to go to 100% because then it would never hit the band. What professional traders look for are several things. Is the market riding a band? Does the market hit it and back away? There's different ways that you look at it. What I teach in my course is that often the first time you hit the band is where pros are coming and taking money off the table. So off the table would mean if you go to the lower band, I'm assuming that the pros, because the market was under the 18-week average, were short. If the market was going up, the market hit the 18-week average back here, I'm assuming they took some money off the table there. That doesn't mean they can't get back in. There's also a condition where you ride the band. You just stay glued to it, and that often is accompanied when momentum, which leads price, at least that's what I teach in my charting course, leads price, and as long as it locks in, prices are good. But momentum can also lead price down. And if you take a look right here, this was the break of the market, and it's really never recovered since that time. So we have a market that still has momentum down. It's sort of arcing sideways right now. The bias is down. You stepped out of a trend, and the market did hit the first support. The NASDAQ has a different looking chart. Nothing's agreeing. Everything, we've got divergence. That's the right word. Let me explain it. You've got higher lows and certainly higher highs. You'll notice that when you hit that upper Bollinger Band, you fell back and fought a battle for a couple of weeks at this 18-week average. If that gives ground, I'd look for the lower Bollinger Band. Market comes down, hasn't quite hit it, but made two runs at it. Now, that's not unusual because if I go all the way back to 2017, again, this is a market that stayed mostly over the 18-week average. So it's just getting its feet wet to breaking down. Hitting the lower Bollinger Band is a target, not all the targets. Where's the neutral point? The 18-week average of closes. When you close under the 18-week average, I call the market having downside bias. Close over it, it has upside bias. Momentum is either pointing up or down. That's how I use on a weekly chart the slow stochastic. I use it very different on a daily chart. In the Dow Jones, I'm going to say the same thing. You lost your upside momentum. The market, I think you'd agree with me, fell and then came back and fought, watch this, at the 18-week average. You slid through it, but you closed right by it. Now you got back over it. Now you're fighting at it. You're looking for direction, and the market ultimately starts down. Again, this market did hit that lower Bollinger Band, went right to it, held it, and you've had a bounce. But I'm going to call the trend in this market down. You have a pattern of lower highs, lower lows. The bias is down since you closed under the 18-week average of closes, and momentum is still pointing down. So I continue to see resistance at 24,928. What I wouldn't want to see taken out if I were bearish on the market is 25,510. I'm not interested yet in risk. I'm just looking at the market off of a weekly chart. I think most people trade off the daily charts, but they use the weekly to get an idea of what the bigger picture is and maybe how do they enter it. When you come to the Russell 2000, you have a pattern of lower highs. You've had lower lows. With this week's close, you suddenly have a higher low. So you've got a market that's doing this. It's bringing itself in like that, and the center point of the market is the 18-week average. Resistance, 1618, support, 1481, momentum flat. Bias up because you're closing over the 18-week average, but the trend with the legacy, the first thing that happened were a high and then a lower low, then a high that didn't take out that high, then you came here. So I leave the legacy of the lower highs in place and say this market's pretty much out of whack. When I come to the VIX often, and if you watch the daily tapes I make, you'll see this pattern develop on a lot of charts. On daily basis. This is where trends come from. Ultimately, you break out of these Bollinger Bands. In this case, it destroyed itself by going up to 50, and as fast as it went up, it fell back. It was, for this market, remember the term mini flash crash? Well, this was a mini flash bang to the upside, and as fast as it went up, it came down. But I don't believe we're going back to these lows. I think that the next break low will be near the highs of what we had in 2017. And on this market right now, the trend is still up. Higher lows, certainly higher high, but just like I pointed out, you now have a lower high on your most recent pattern. Something else happened on this chart. I want you to look at the week before. This is called an outside week up. It's when you take out the previous week's high and low and you close higher. If you take out, and this is what, again, I teach in my charting course, and it works on daily charts, in my theory at least, and on weekly charts. If you take out the low of an outside week up within 2 weeks, in other words, 2 time frames of it forming, the odds are the market makes a run for the nearest moving average to the downside. The reason is it's a bull trap. You had a market that took out the previous week, closed higher. You did that this week. I'm looking for the 1601 level, the 18-week average of closes. In the 10-year notes, the market has momentum that's trying to lift up. You see that almost when you made a lower low and a higher high. You're not trending. The market made a run, couldn't get to the 18-day average and slipped back. Hard to tell what the market's doing. I'll call it not trending. In TLT, here's again is that momentum. You've got a market in a downtrend. It's running on the Bollinger Band. Market starts right here, losing the downside momentum. Now we've got a pattern of higher lows, higher highs. Where's the objective? I'm going to argue that the closest moving average could be where it's going, be the 18-day average. And notice where the market's pausing right now. When we come to the dollar index, I see it in a downtrend, but with divergence. I see momentum trying to pick up. The pattern is lower highs, lower lows. You don't have that pattern on the daily charts. You'd have to take out on this chart 90.29 to get the market to break this pattern. If the market starts down, I'm looking for the lower Bollinger Band to be potential support. The bias is down, trend down. Now I need momentum to turn. Momentum often turns before price. In the eurocurrency, you have the same thing. I have a momentum that is trying the down, but now it's starting to skid sideways. In the pattern, you've had higher lows and higher highs over the 18-week average. But you have an argument with this if you go to the daily chart. They're not together at all. The Aussie dollar is losing downside momentum. Do you see that? and it's a market that had lower highs, lower lows. Look at the battleground, that 18-week average. Momentum often leads price. Does it turn up? It's now stalled on the downside. In the Canadian dollar, momentum turned up, and it turned up literally right here. Not this week, the week before. You have higher lows, higher highs, first resistance, the 18-week average. If it keeps going up, it gets to it, and you can see you've got momentum up, the trend up, price up. If you go to the Japanese yen, this market broke this week under this low. It has been having a beautiful pattern of higher lows, higher highs all the way through. Momentum started turning right here, and suddenly this market is turning itself back to the downside. Bitcoin. There's not enough data yet for me to do a weekly chart that looks good. It'll be here soon. They only started trading in December, so need a few more weeks. But the daily pattern is higher lows, higher highs. This is the beauty of daily momentum. This is called embedded, locked in. As soon as the red line turns up, the first objective becomes the 18-day average. Admittedly, it all happened in one day. That is not the typical case. Now, if it keeps going, and it's moving up, if momentum can stay up, possibly the upper Bollinger Band. But you know the support, the trend is up, the bias is up. That's what's important. I can also look at different spreads. Now, one of the popular that I'm looking at is Brent versus WTI crude. And for those of you new, I had been pointing out that when we were down here and the market went all the way up to this area, I started making phone calls trying to find out what was the cost of shipping a barrel of oil from the Texas region, where we get all this shale, out to Asia. And we came up with the idea that it could be as much as $3 a barrel, something like that. Well, as it turns out to be, with it, you got up to nearly $7, fell back to $3.12. If you figure that there's a profit, anything over $3.50 a barrel, it's not uncommon to see that when the market sticks its head up, it gets capped because you can do some conversion. I'm not saying the blends all work perfect, but it's a rule of thumb that you look at. When we look at the weekly bar chart, momentum is up. Remember, I don't look at overbought, oversold on stochastics, the momentum indicator. The trend has been up. Trend turned up back here, higher lows, and as soon as you took out that high, higher highs. Where's the objective? The upper Bollinger Band. Market still hadn't hit it, pulls back to support at the 18-week average. Momentum starts dropping on you, then turns back, and you hit this week the upper Bollinger Band. So we have a market that's in an uptrend. Momentum is up, bias up. It stays that way unless you take out on the weekly chart 66, 69. WTI, it's the same thing. Momentum up, you're up to the objective area, the resistance area where you broke from before. So you look at Bollinger Bands for the idea, where could pros be looking to come out? They're going to look at a combination of momentum and that number. It's one of the ways to look at trading. Natural gas is doing something very interesting. For the first time in a long time, it's putting in higher lows. I think you see that. And this week's high just took out by one tick last week's high. So I'm going to call the trend on the swing line up. The bias is down because you're under the 18-week average, so I'm going to look at 280 as a resistance area. And momentum is flirting with trying to turn up. You can see that the red is now over the blue. If I go back in time, it wasn't. It's just trying now to turn itself back up. And that's why I try to put charts together. Admittedly, most traders will work off of daily charts. And in my charting course, I teach you how to put together a swing line. And I make you do it by hand at first. I give you the charting software to do it, the drawing skills. I teach you what is a trend and how do you define risk within a trend. Then we filter that with moving averages. And you're going to learn a series that I don't even show here intentionally. Then I give you my tricks for the momentum indicator called the slow stochastics. It's years of experience. Tricks isn't the right word. It's tools of the trade. Bollinger Bands. This has been around. It's an extremely popular tool. I have my own twist and turn on it. And by the way, for all of these chart things that you're looking at, I have met most of the people that developed them over the years. I've had my own radio and TV shows over years, and I've learned from the people that created them. So you're learning what I learned as time went on. You're learning how to put this all together and come with it your own way. Another trading tool, the window envelopes, a profit-taking tool. You'll get to the chart that looks like this. Then you get my market research videos and the like. How do you get this and how do you find out more? Because we're getting long here. Go to www.iraepstein.com. You can go to our website. Of course, that's the way to do it. You can click up here if you're watching me on YouTube. It'll take you right there. Or call my staff, 866-973-2077. The course, very inexpensive, $129.95, including the charts, the market research, 6 hours of videos. Everything's online for you. I'm Ira Epstein. Have a great weekend. I'll see you Monday.